The property residual market pools, fair plans, beach and windstorms, plans assigned risk and others. A pool is an organization of insured or pre-insured through which particular types of insurance coverage are provided. The pool acts as a single insured entity and opposed to some just and assigned risk plans where the policyholder deals directly with an individual insurance company. Premiums, losses, and expenses are shared among pool members in agreed upon amounts. The range of activities handled by the pool varies. Some pool operations are limited to redistributing premiums and losses, while others have broader functions similar to an insurance company. Some pools use specific insureds as servicing carries. In pools composed of primary companies, business is placed directly with the pool by the agent. In our insurance pool, a member company underwrites the risk, issues the policy, and insures the business in the pool. See below. Pools may be mandated by state legislation established on a voluntary basis. Pools ensure that insurance is available to property owners in high risk, generally urban or coastal areas, and business with a poor safety record or other high risk characteristics. Among the best known primary pooling agreements are property insurance plans such as beach and windstorm plans, which insure owners of properties vulnerable to storm damage. Fair Plan 32 states and the District of Columbia currently have property insurance plans known as FAIR, an acronym for Fair Access to Insurance Requirements Plans. The concept of FAIR plans was established following passage by Congress of the Housing and Urban Development Act of 1968 and measures designed to address the conditions that led to the 1967 urban rights. This legislation made federal right reinsurance available to those states that institute such property insurance pools. One of the plans, rural risk areas where fire protection is poor or non-existent, Mississippi rural plan, which offered fire extended coverage and Mandalin Sea below, was expanded to cover the entire state in 2003. Georgia Fair plans also provide windstorm and hail coverage in coastal county, uh, as do plans in and New York. In most states where fair plans are in operation, they are mandatory. Beach and windstorm insurance plans counterparts to the fair plans are beach and windstorm insurance plans operated by property insurance in states along the Atlantic and Gulf Coast to ensure that insurance is available for both residents and commercial properties against damage from hurricanes and other windstorms. Established between 1969 and 1971, beach and windstorm plans operate in a manner similar to fair plans, except that properties must be located in a designated area to be eligible for insurance under the plans. There are currently 5 beach and windstorm plans: Alabama, Mississippi, South Carolina, North Carolina, and Texas. In 2001, there was 7 pools, but Florida Windstorm Pool merged with the Joint Underwriting Association in 2002 to create a new type of residual market entity. See below. In a similar move in 2003, merged its fair plan with its castle pool. The plans are mandatory in all of these states with the exception of Alabama. In addition, hail and windstorm coverage for home in the coastal countries is available through some fair plans. See above and the wind map. In New Jersey, windstorm plans in Mississippi, South Carolina, and Texas offers only wind and hail coverage. Plans in Alabama and North Carolina offer coverage for fire and well. In some states, plan policyholders must buy flood insurance also. Property owners who live in areas covered by beach and windstorm plans may be insured for windstorm losses by the plan. The advantage of beach and windstorm plans and the National Flood Insurance Program is that the availability of insurance encourages development of coastal areas where construction otherwise would not be feasible and where tax money must be spent to protect against continuous errors to preserve the property. In the past, there was a clear delineation between coastal and urban plans, with coastal properties insured under beach and windstorm plans and urban properties under fair plans. Increasingly, the distinctions are blurring. Fair plans and acting as an insured of last resort for residents who live in shoreline communities in states but do not have a beach and windstorm plan, such as New York State beach and windstorm plans in some states, and being merged with fair plans or joint underwriting association as in Florida and Louisiana, or and administrating new fair plans as in Texas. As a result, it is difficult to compare the number of properties insured under any plan with numbers from earlier years. Fair plans have almost doubled in size, pushed up in large part by these merge and the increase in coastal properties in such states as New York and Massachusetts, but also by more stringent underwriting standards on part of insurers in the voluntary market. Residual market plans merged in 2002 Florida two residual market organizations, the IJA and the Florida Windstorm Underwriting Association, merged to become the Citizen Property Insurance Corporation. The Florida CPIC, known as Citizen, has a tax exempt status. This feature enables it to finance loss payment in the event of a major disaster by issuing tax exempt bonds that carry low interest rates, thus reducing financing costs over the years by hundreds of millions of dollars. In Louisiana, following Florida model, the FAIR plan and the Coastal Plan became the Louisiana Citizen Property Insurance Corporation in 2004. The residual market entitles jobs for other lines of insurance. Jobs are not limited to automobile insurance. At various times, there have been jobs for residential insurance and works compensation. A number of states have medical malpractice jobs, most of which were set up in the 1970s or 1980s when the line was beset by high losses. Market assistance plans. A MAP is a temporary voluntary clearinghouse and referral system designed to put people looking for insurance in touch with insurance companies. They are organized when something happens to cause insurance companies to cut back on the amount of insurance they are willing to provide. Maps are generally administered by agents associations which assign insurance applications to a group of insured doing business in a state. These companies have agreed to take their share of applicants on a rotating basis. Maps may be organized for a single line of insurance, such as daycare liability or homeowners insurance, or for a broad range of liability coverage. Homeowners insurance maps have been formed in several East Coast states, including Connecticut and Texas, and medical malpractice maps were created in states such as Washington when the medical community had difficulty finding malpractice insurance workers compensation, assigned risk plans and pools. The mechanism used to handle the workers compensation residual market varieties from state to state. In the four remaining states with a monopolistic state workers compensation fund, North Dakota, Ohio, Washington and Wyoming switched. All businesses are insured through that fund in that state with a competitive state fund and entitled that efforts for business with private ensure the funds accept are rejected by the voluntary market, thus eliminating the need for signed risk plans instead without a competitive fund insured may be signed applicants based on their market share and service loss employers and as they would employer that came to them through the voluntary market through a system known as direct assignments. They may also participate in the residual market through a pre-insurance pooling arrangement. कल भला के मैम को बता दिए थे ये चीज़ Second injury funds. Second injury funds were created to encourage business residual effects of an accident of illness, but due to other laws, but that now protect the physically happy handicapped worker, such as the Americans with Disabilities Act. Some states are disbanding their funds. Second injury funds receive money from insurance companies and employers as well as all as from legislative appropriations. Insurance company payments may be based on a percentage of total compensation paid, premium collected, or the nature of the specific injury. The second injury funds may be administered by the State Workers' Compensation Commission, Industrial Board, or Departmental of Labor.